Choice no fault in choice no fault. In choice no fault states, drivers may select one of two options: a no fault auto insurance policy or a traditional tort liability policy. In New Jersey and the no fault option has a verbal threshold. In Kentucky, there is a monetary threshold. Tort liability. In traditional tort liability states, there are no restriction on lawsuits. A policyholder at fault in a car crash can be used by the other driver and by the other driver's passengers for the pain and suffering the accident caused, as well as for out-of-pocket expenses such as medical costs. In add-on state, drivers receive compensation from their own insurance company as they do in no-fault states, but there are no restrictions on lawsuits. The term add-on is used because in these states first-party benefits have been added on the traditional tort liability system. In add-on states, first-party coverage may not be mandatory and their benefits may be lower than in true no-fault states. Regulation. Insurance is regulated by the individual state. The move to modernize insurance regulation is being driven in part by the globalization of insurance services. Some large US companies that operate in other countries support the concept of a federal system that provides one-stop regulatory approval, while others believe the merits of a state system outweigh the virtues of a single national regulator. As a result of discussion about the merits of each system, states are making it easier for insurance to respond quickly to market forces. State monitor insurance company solvency. One important function related to this is overseeing rate change. Rate making it is the process of calculating a price to cover the future cost of insurance claims and expenses, including a margin for profit. To establish rates, insurers look at past trends and changes in the current environments that may affect potential losses in the future. Rates are not the same as premiums. A rate is the price of a given unit of insurance. $2.50 per $1,000 of earthquake coverage. For example, the premium represents the total cost of many units. If the price to build a house is $1,50,000, the premium would be 150 x $2.50. Rates vary according to the likelihood and potential size of loss. Using the example of earthquake, insurance rates would be higher near a fault line and for a big house which is more susceptible to damage than a frame one. Will the regulatory process in each state vary? The principle guide every state's rate regulation system that rates be educated to maintain insurance company solvency, but no excessive, not so high as to lead to exorbitant profits, nor unfairly discriminatory price differences. Must reflect expected claims and expense differences. Recently, in auto and home insurance, the twin issues of availability and affordability, which are not explicitly included in the guiding principles, have been assuming greater importance in regulatory decisions. In line with these principles, states have adopted various methods of regulating insurance rates, which fall roughly into two categories: prior approval and competitive. These does not mean there is no competition in state using a prior approval system. Most approved rates in prior approval state are the rates used, but in some causes, particularly in commercial coverage, companies compete at rates below these approved ceilings. Regulation, monetization, increasingly, even in the most regulated state, officials are laying on competition among the insurance companies to keep rates down and are modernizing and streamlining the rate setting process. The move to modernize insurance regulation is being driven in part by the globalization of insurance services. Some large US companies that operate in other countries support the concept of a federal system that provides one-stop regulation approval, while others believe the merits of a state system outweigh the virtues of a single national regulator. As a result of discussions about the merits of each system, states are making it easier for insurers to respond quickly to market forces. Since 2009, various pieces of legislation have been introduced in Congress that respond to a number of concerns. Lack of an entity at the federal level that can represent insurance interest, particularly in the discussion of international issues, the need for better oversight of systemic risk, the interconnectedness of the risk assumed by a few large financial service companies whose failure could bring down the entire financial system, and the need to streamline the regulation of reinsurer and surplus lines insurers. For example, in Georgia, a law was signed in May 2008 that allow auto insurance companies to adjust most rates without the prior approval of the insurance commissioner. Georgia joined at least 30 other states that let rates more closely reflect competition in the marketplace. Type of state rating laws. Prior approval. The insurer must file rates, rules, etc. with state regulators. Depending on the stated, the filing becomes effective when a specified waiting period elapses. If the state regulator does not take specific action on the filing, it is deemed approved automatically, or the state regulator formally approves the filing. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. Modified prior approval. This is a hybrid of prior approval and file and use laws. If the rate revision is based solely on a change in loss experience, then file and use may apply. However, if the rate revision is based on a change in expense relationship or rate classification, then prior approval may apply. A state regulation may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. Flex rating. The insurer may increase or decrease a rate within a flex band or range without approval of the state regulator. Generally, either file and use or use and file provision apply. Generally, the insurer must file rate increases or decreases that fall outside the established flex band with the state regulator for approval. Typically, prior approval provision apply. The flex band is set either by statute or by the state regulator. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish in non-compliance. File and use. The insurer must file rates, rules, etc. with the state regulator. The filing become effective immediately or on a future date specified by the filer. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. Use and file. The filing becomes effective when used. The insurer must file rates, rules, etc. with the state regulator within a specified time period after first use. A state regulator may disapprove a filing at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance. State prescribed. The state regulator determines and promulgates the rates, classification, forms, etc. to which all insurers must adhere. Insurers are usually permitted to reserve from state prescribed rates, classification, forms, etc. with the approval of the state regulator. No-file record maintenances. The insurer need not file rates, rules, etc. with the state regulator. Rates, rule, etc. become effective when used. The state regulator may periodically examine insurers to ensure compliance with the law. Generally, there are record maintenance requirements under which insurers must make their rating system available to the state regulator for examination. A state regulator may order discontinuance of the use of the material at any time if it is not in compliance with the law. The state regulator normally must hold a hearing to establish non-compliance.